AI has the potential to reshape industries. Come learn about how it might change impact investing.
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors. It is Friday, July 5th, 2024. I hope you all had a relaxing July 4th. We're able to celebrate with your friends, your families, enjoy the barbecues, the parades, and are ready to get back to work. My name is Luke Guerrero, and this is InvestTalk, and we have one objective on this show, day in and day out, and that is to help make you a better and more informed investor. Now, in order to accomplish that, as you well know, we have a mixture of some educational items, some actionable items, ways that you can look at your financial and career lives to determine if you are on the right track. And of course, most importantly, we answer your finance and investment questions live, via voicemail, or on our InvestTalk YouTube channel. Now, we'll run down today's show topics and talk a little bit about the market, but after we get to our first caller question now.
Hey, Justin and Luke. Love the show. Calling about Hudson, HDSN. It's pretty beat down, had a bad first quarter earnings, lost some government revenue, but fundamentally to me, it looks good. I'm wondering if you agree and what you think of sort of its overall the macro situation. Thanks. Look forward to hearing the answer.
So Hudson Technologies, HDSN is the ticker, is a refrigerant reclamation company. I believe it's actually the largest refrigerant reclamation company in the US. For those of you who don't know, refrigerant reclamation is essentially a process by which you can recycle gas that has already been used within cooling systems. And heading into the year, there was a lot of hype around this name, and for good reason. It's fundamentally a very solid name. But I think after their Q1 earnings, they revised, or maybe it was even earlier in the year, they revised down their outlook for the year on revenue by 25%. Q1, their earnings didn't look great on revenue, didn't look great on gross margins. So, you have to ask yourself, is this just a current issue, or is this indicative of what the future means for the industry? I don't think it's I don't think it's indicative of what it means for the future of the industry. I think it's really just a flash in the pan issue here. So let's take a look at the company itself. First and foremost, it has pretty much no debt, $7 million of debt on a $385 million market cap company. Now it's down 38% year to date. It was certainly on the upper half of the micro caps earlier in the year, but it's been run down a lot again because of the forward-looking guidance and because of disappointing earnings. Now, even with that being said, their cash flow looks pretty positive. It's been on an uptrend since 2022, and even with disappointing earnings, their cash flow has been improving. Their profitability has fallen a little bit, as denoted by their net margin here. It really peaked out in 2022 at 31%. It was 18% last year, projected to only be 13.7% this year. I think this company is in an industry that, given the demands of cooling, given the demands of energy cost of artificial intelligence, the sensitivity of some of these chips, and some of their customer base, I think that, like I said, this is really just a flash in the pan issue here. So you want to ask yourself, is this company positioned fundamentally to succeed when demand starts to pick up again? I think it is. I think it is capitalized very well. Again, very little debt. I think its cash flow is on the right track. I think its profitability is coming down to more realistic long-term margins. They've been issuing a little bit of shares, but not too many shares. And so what this pullback has done is it's put it in a range where it has a more reasonable valuation. Price to book value of 1.6, forward-looking price to earnings of about 10 times. Its average over the past 5 years was about 23 times on price to earnings and 2.2 on price to book. So for me, this is a good company that has had a pullback because of demand reasons, and it's positioned itself very well to succeed in the future. Is now the right time to buy it? I don't think so. It just broke down beyond its support, just below $9. It's currently trading at $8.33. So until you see a consistent breaking of its downtrend that it's had since February, until you see it find really a bottom, I wouldn't put it in your portfolio, but I would certainly keep it on my watch list because I think it is a good name. Thanks for the call. Now, we got a lot of ground to cover in the next 45 minutes or so, and here's some of what I have planned for you, time permitting. My main focus point is about something that maybe you've heard of, and that is artificial intelligence. Really just artificial intelligence in finance and how that has impacted all sorts of things, including impact investing. Because AI can certainly enhance impact investing, investments that generate social and environmental impact alongside financial returns, by improving data analysis, decision making, and impact assessment. However, it is crucial to mitigate risks and align AI tools with core principles to avoid the systemic biases that have been certainly inherent in some of the ways that traditionally things are funded. And we'll dig into that. What does all of that mean? What does it mean for AI in finance? And what does it mean for impact investing broadly? We'll also talk about a new Fed report on inflation and the jobs market that was released today ahead of some congressional testimony by Jay Powell, I believe, next week. So we'll dig into that. What does that mean about the longer term trends? We'll also touch on the Bureau of Miners. You may have never heard of it, and that's because it doesn't exist. It was shut down in the 90s. But given some of the demands of the mining industry, maybe it's time for it to be started up again. Also, should we have time at the end of the show, we'll touch on NVIDIA's revenue coming out of China in spite of increased tensions and increased regulations. So we'll dig into that. What does that mean for the company? How are they circumventing some of the... It's the word I'm looking for. Some of the sanctions and some of the desires, if you will, of the US government in not supplying technology to China. We also have a host of questions to answer, one on INTC Intel Corp and one on RCI Rogers Communications Inc., as well as some questions that came in from the comment section of the InvestTalk YouTube channel. And of course, we welcome your finance questions now, live at 888-99-CHART. That being said, we're going to go into a short break, and on the other side, we'll talk about today's market activity and sum up the market activity for the week. Please remember you can call anytime and leave your questions on the InvestTalk voice bank at 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Thanks for watching, and don't forget to like and subscribe and turn your notifications on because you don't want to miss a single episode of the InvestTalk podcast. Welcome back. Now let's talk a little bit about the market today. U.S. stocks finished mostly higher. Dow up 17 basis points, the S&P 500, large caps up 54 basis points, NASDAQ up almost 1% at 90 basis points, and the Russell 2000 diverging from the trend down almost 0.5%. Now, with that being said, the S&P and NASDAQ both logged solid weekly gains and fresh record closing highs. The equal weight index, little changed, because big tech mostly drove those indexes gains. Meta, notable gainer. Tesla capped off a almost 27% week-to-date increase. Other outperformers included software department stores, off-price retail. Underperformers were small caps, as I previously mentioned, banks. Really ahead of bank earnings next week. That's certainly something of note. Insurers, chemicals, steel, energy, also some underperformers. Gold looks like finished up 1.2%. Bitcoin down almost 5% in its third straight session of losses. Crude oil settling down almost 1% itself. Overall, it's a pretty low volume session today, as to be expected given the holiday yesterday. When you think about most holiday shortened weeks, the holiday usually comes on the Monday or the Friday. But essentially what you ended up having here is you have a holiday on a Thursday, you have a low volume day on Friday, you have a market half day on Wednesday. So overall, a low volume week. And so when you think about the economic data that comes in, is the low volume enough to really tell you what a lot of market participants think? Not really. But regardless, June non-farm payrolls report came in today, saw growth of 206,000, better than the 190,000 consensus, but there's still a notable downward revision to May's outsized results. Elsewhere, the Fed's Williams again highlighted progress in getting inflation down following an unsurprising minutes release on, I think Wednesday was that minutes release. Not a lot of corporate news on the corporate side. Though next week, as I mentioned, marks the start of Q2 earnings season. On the bullish side for the week, more support for the Fed's rate cut after cooler than expected data, July seasonality, also seen as a support with B of A noting this week's first 10 trading days of July, that is, are the strongest such period for the S&P since 1928. Earnings growth estimates also holding up with consensus Q2 EPS growth of about 9%, which is the highest it's been in 3 years. Now, on the bearish side, there were some growth concerns this week. Bloomberg's consensus 2024 GDP growth also saw its first markdown of the year this week to 2.3%. The historically low VIX, also seen as really maybe an indication of some complacency risk. And as I mentioned, the equal weight S&P didn't do as well. It didn't really move that much today. And so the narrow market breadth continues, as well as a high bar for earnings given where the earnings estimate is. Looking ahead to next week, CPI and initial claims will be on Thursday, PPI producers prices on Friday, and bank earnings next week. That's the market today. Now, I hope you've been telling your friends that our InvestTalk audio podcast is also now available on video form. And we love it when you go over, watch the show, and leave us finance and investment questions. So let's get to one now. This one's from Corey Houston, and it's on dollar cost averaging. It says, I'd like to start dollar cost averaging into the market without having to become a day trader. Would you recommend automated stock investing with someone like Wealthfront, or a simple 3-5 fund strategy with a typical brokerage account? I currently have a Roth IRA and a company 401k, as well as an investment in Ethereum and Bitcoin, long-term hold in parentheses. So I'm not necessarily new to investing, but I would like to maximize my time without having to keep up with too many individual stock investments. So for those of you who don't know, dollar cost averaging is the practice of continually investing, sometimes the same dollar amount, sometimes differing dollar amounts, but regardless, you are consistently over time investing in the market. And so the reason why it's called dollar cost averaging is, say you want to buy a position of a mutual fund or a stock, you buy it over longer periods of time, your dollar cost is averaged over all of those purposes, or all of those purchases. That's why it's called dollar cost averaging. And there are different ways to accomplish this. Yes, you could have a simple 3-5 fund strategy. You could do it weekly. In this case, it sounds like he wants to do it daily, he or she. And so Wealthfront is a good way to do that. I think overall, the message here is, right, if you don't want to spend too much time in investing, I've always said this, passive indices, or rather passive index tracking funds, or wide, diverse, cheap ETFs are a great way to do it. And so if you have a simple strategy like that has 3 to 5 funds, then dollar cost averaging really won't take up that much time. And so if your goal here is to invest in the future, average into your positions, and spend the least amount of time possible while trying to reach your financial goals, I think, the best idea would be to have a 3 to 5 fund strategy, and then periodically just go in and just buy. Right. And so what that will do in effect is you're averaging the price, you're constantly investing in the market, but you're not spending as much time researching individual stocks, and you can spend the time doing what you would rather do and what you really love. Thanks for watching, and thanks for leaving the comment. It looks like we actually have another InvestTalk YouTube channel comment question that we'd like to get to. This one on COWZ, ticker COWZ. And I know this fund well because I feel like we get questions about that a lot. And so this question is, I was wondering what you think of taking a position in COWZ ETF for a mid to long-term hold. And so COWZ is essentially it's the US Pacer cash flow or cash COWZ 100 ETF. What they do is they take the Russell 1000, which is US large caps, and then from there they pick names based upon profitability metrics, right? So they take 100 names and they screen companies based on their average projected free cash flows and earnings, if available, for the next 2 fiscal years. And so what this is really doing is it's giving you a prof tilt within the large cap space. So let's take a look at how that breaks it down for you, exactly how you'd expect. Technology is only about 19%, whereas in the MSCI USA large cap, it's about 43%. So this is going to overweight names like technology, like energy, like consumer cyclicals, some healthcare. Healthcare is actually at a decent weight here. And as I mentioned, primarily large caps. The Russell 1000, mostly large caps. This actually dips down to about 60% of large caps. I think overall, this is a good name. Some of these top names we hold for clients. It tilts towards profitability, which historically has been the sector of the market that overperforms, and it does it all for you at about 49 basis points, so a little bit expensive there. Overall, I think it's a fine ETF. I like how it's constructed, but maybe a little too expensive. Thanks for the comment. We're moving into a break. It's still to come, my main focus point and in newsletter preview. Feel free to leave your questions anytime at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions. Now, my main focus point today is about artificial intelligence in finance and how that relates to the future of impact investing. Now, as we all know, AI can enhance. It can be a tool for enhancement in doing your everyday tasks. So how is that going to apply to some areas of financial markets and financial service companies? So let's dig in. As we all know, and as I mentioned, artificial intelligence is rapidly integrating. And with that integration, there's been the promise of revolutionary changes in managing investments, analyzing risks, and processing credit worthiness. What do I mean by that? Well, underwriting loans for companies, underwriting loans for individuals. And so the reality is large banks are already using artificial intelligence to offer credit based on these automated analyses of spending patterns and income without the need for those traditional applications. But there could be an issue here. And that's because this surge in AI capabilities has some pretty significant concerns. It has a lot of questions. One is, how will this shift affect those already marginalized by our financial systems? Another, what steps can we take to mitigate negative impacts? And crucially, how do we ensure AI does not simply perpetuate the existing biases embedded within financial systems? While AI's potential as a screening tool for lending and investments is appealing due to its speed, accuracy, and supposed objectivity, there's a real danger here. The danger is that these AI systems could continue to exclude worthy applicants by leaning on historical data that mirrors past human prejudices. And this is the case with a lot of artificial intelligence, right? If you train things on historical data, let's give you an example here. Let's say you wanted to make a model that creates a book for you, and you only fed it William Shakespeare, okay? You wanted it to make plays and that's all you fed it. Well, then what it's going to spit out is going to be indicative of his writing style, right? If you fed it Charles Dickens, it's essentially going to write you a Charles Dickens novel. And so the same thing applies here. If you are creating models based upon how you would fund businesses, it's going to be biased towards how businesses have been funded in the past. So here comes impact investing. And for those of you who don't know impact investing, it's the idea of investing for positive social impact and positive returns. And so it's a sector that's still in its formative stages. There's really little historical data about how successful it can be, particularly in areas traditionally dominated by nonprofit interests. And so now that these for-profit investments are coming in, there's not a lot of, like I said, not a lot of historical data. And so impact investors are thinking about the problems with artificial intelligence. And so they're trying to counteract these risks. They've been looking for ways to invest in companies that are developing AI tools that don't solely depend on the flawed data from our existing systems. One of those initiatives, like the one by Village Capital, aims to create a framework to reduce these biases by grounding AI tools in rigorously tested, bias-aware methodologies. These frameworks could significantly improve the equity of AI-driven financial decisions if widely adopted. Now, another area where AI may be lacking is in the, let's say, nuanced understanding of people and personal connections. Because while AI may enhance some aspects of investor, entrepreneur, or investor-client relationships, really what it's best at and what it can be best at is being a tool used by those who are already within that industry. You can provide basic management. It can help with organizational structure advice. But what it can't do is really replace the nuanced understanding and personal connections that human advisors in these areas offer. So honestly, in my opinion, the challenge is, and has always been, how to integrate AI and integrate these models in a way that complements human judgment a way that complements it without replacing the valuable human elements of business coaching, relationship building, investment management, corporate structuring. Looks like we got a live call from Bill in Hayward, who has a question about General Electric. Do you own it, or are you looking to buy it?
I own it. Thank you for taking my call. Yeah, I bought shares before the organization, and so now I have positions in GE and GE Vernova. Mm-hmm. And I just wanted to get your take on those two securities, and is it something that one should hold, long-term balanced portfolio going forward? What do you think?
Yeah, of course. So let's take a look at GE first and foremost. GE Aerospace recently had some spinoffs, and I don't think I have to tell anybody who is listening what GE does. It's a very, very large company. It has really some interesting turbine engines that I was reading one time was the product of several happy accidents such that it is very difficult to replicate those engines if you were to start from scratch. Why am I saying that? Because that is a way of essentially telling you that this company has a very large, very complex corporate moat. Now, in the past year, it's up about 85%, and that's even with its sales revenue declining from 2022 to 2023. 76 billion in 2022, down to 67 billion in 2023. Now we're about to actually head into a break, which means I will finish answering this question when we get back. We'll dig into the fundamentals of GE and if it is still a good company to hold. On the next Invest Talk, though, we'll look into this topic: how Fed rate cuts impact gold prices. Analyzing past trends, gold has historically delivered positive returns during periods of interest rate cuts by the Federal Reserve. Will this time be any different? That's Monday, but for now, I'm Luke Guerrero, and I'm ready to take your calls at 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next Invest Talk podcast. Before we headed into the break, we were answering Bill from Hayward's question about General Electric. And so I want to take a step back and say that oftentimes when companies break up like this, because GE's Aerospace is now GE Vernova is their power and renewable energy segment. And so oftentimes when companies split up like this, it's because as a group, they become too much of a bureaucratic mess where the sub-industries aren't really helping each other. Or rather, the divisions aren't really helping each other. And so this is actually a great opportunity for the management of GEV to break off and the management of GE Aerospace to run companies that essentially are more efficient vehicles for bringing products to market and more efficient in terms of costs. And so that's a situation of what I think happened here. We talked before the break about GE Aerospace having a very strong moat in the power of its jet engines. And actually, as demand started to increase a little bit, they were big beneficiaries of that. And I think even though it's probably going to taper off, I still think that the moat they have is so strong such that owning GE is still a good idea. Now, turning to GE Vernova, which is that power segment, I think, as I believe I answered last week when somebody called in, that this is also a great company to hold. This specific business segment has good executive leadership that can turn around some of the issues that they had when they were one giant entity. And not only that, it's a cash cow. Net operating cash flow, $1.1 billion, projected to be $1.7 billion next year. Yeah, I think the spinoff, the separation was a good idea. I think they have good executive leadership in place. So I would give you a thumbs up for holding on to both of those names. Thanks for the call. Okie dokie. Let's shift gears and head back to, actually, before I head into the next talking point, I wanted to briefly mention our KPP Premium Newsletter because it's Friday, which means it will be distributed tomorrow. This week in the KPP Insight section, we're talking about QE and QT. For non-finance nerds, or maybe you haven't heard of it, it's quantitative easing and quantitative tightening. So what do those things mean? because they're new. They're relatively new. It is something that has really just appeared in the wake of the 2007 financial crisis. Did it work? Is it working? What's going to happen next? In the stock ideas section, we mentioned an energy company and a financial services company. And in the portfolio management section, we touched on an important topic in my mind, which is navigating the global markets, especially in the wake of asymmetric returns between US stocks and international and emerging market stocks. So hopefully that'll help you understand how to best allocate your portfolio and, again, navigate through a global world. If you're interested in learning more, visit us at InvestTalk.com and hit subscribe. The newsletter will come to your inbox every Saturday morning. Now, shifting back, let's talk a little bit about a new Fed report. And so what that shows is that inflation has shown some signs of easing, and the job market appears to be really stabilizing as it returns to conditions more akin to those before the pandemic. And this latest report is released ahead of some testimony in front of Congress. Now, the report highlights a decrease in inflation, particularly within the housing services sector, suggesting it might soon revert to those pre-pandemic levels. Labor dynamics, which it also talked about, it seems as though they are normalizing. Demand's cooling slightly and supply bolstered by strong immigration rates. Notably, though, nominal wage growth has continued to slow down. And this wage growth really has aligned more closely with the pre-pandemic trends. Now, the Fed's observations are timely. As I mentioned, Chair Powell is scheduled to testify before Congress next week, a discussion that will likely emphasize the central bank's monetary policy as the U.S. enters a politically sensitive period. And with job growth slowing and the unemployment rate ticking up from last year, the focus can now remain, as it always really has been, or rather as it has been for the past 2 years, on inflation, which is still considered elevated, though it is gradually approaching more acceptable levels. And so this upcoming testimony and new inflation data set to be released soon could influence the Fed's future decisions. You've seen it today. They seem to be walking towards an area where potentially they can open discussions about rate cuts as early as September. And so amidst this discourse, the Fed emphasized its commitment to independence from short-term political pressures. And that principle has really been enshrined to ensure that monetary policy decisions focus more on those long-term employment and price stability goals rather than short-term changes. Both Democratic and Republican lawmakers are likely to probe Powell extensively on whether the Fed's actions align with those standards of independence, especially given the diverse opinions on the timing of potential rate cuts. And so the debate will continue over the appropriate levels of interest rates moving forward. I think overall, the Fed's report to Congress kind of paints a picture of an economy on the mend, but still navigating significant challenges. So with a central bank walking a tightrope of policy decisions amidst complex political and economic landscapes, it'll be interesting to see what market-moving words Powell has for Congress next week. All right, let's pivot back to the InvestTalk voice bank and play a question that came in earlier from Philadelphia.
Hey, Mook and Justin, Bill from Philadelphia here. Wanted to ask you guys about Intel, INTC is the ticker. I feel like it could be a good buy at this range. It's hovering around that 30, 31 area. I think the government has backed it a lot in the upcoming infrastructure deals for creating plants and infrastructure for them within the U.S. I like that a lot. So wanted to kind of get your thoughts if it's a good time to buy some. I've been interested for a bit now, and I think this could possibly be the next big mover with regards to chips, since it's been running behind the NVIDIAs and the AMDs. So I think it could possibly get its chance as well. Love what you guys do. Thank you.
So the question was about Intel, ticker INTC, and Intel has had a rough time, especially in the wake of disappointing earnings and disappointing forward-looking guidance recently. They're set to report again towards the end of July on July 25th, so that'll be interesting to note. And even though it was up over 2%, almost 2.5%, today, year-to-date, it's down almost 40%. And that's because the big driver of growth within the tech sector, artificial intelligence, or really those models and those chips, Intel has been lagging. And you see that in their sales growth. right? It's over the past 5 years kind of dropped, right? 70 billion in 2018 down to 54 billion in 2023, projected to grow a little bit to 55 billion this year. But still, the bear case for Intel is that they will never be able to catch up to what NVIDIA has done. I disagree with that. I think, as I've said before, that NVIDIA's success is predicated on a lot of conditions being the case. One is that their advantage in their chips can't be overcome, which is never true or rather often not true of products. Another is that their chips are necessary because larger, more diverse, wider models are better at processing than smaller, more niche ones. And so there's a lot to be seen there. So I think that one of the benefits to Intel in the wake of this weak guidance is that they seem to be playing the long game. They're transitioning to this internal foundry model of internal production and streamlining their production. And so in an opportunity, I think this really presents an opportunity given where Intel has moved. I mean, look at that, down 1% over the past 52 weeks. Think about how this tech sector broadly has moved over the past 52 weeks. And so you've come to a situation where Intel, which has a lot of government contracts, has come down to about 20 times forward-looking earnings, 1.3 times on price to book. This is essentially unheard of within the tech space. So I think Intel over the next 5-10 years is going to do well with what they're doing in terms of improving their efficiency and improving their internal building of some of their products. Is now the time to buy it? Let's look at where the price action over the past year. I mean, it's been consolidating since April. I would probably wait to see what they say in earnings, given that we're just a couple weeks away. But overall, I mean, technically, it looks like it might be about time to buy it. It's been consolidating around the 30 to 32 range for quite some time. So I agree. Intel is a good name to keep on your watch list. The time to buy might be soon. Thanks for the call. Now let's keep it moving and make it 2 in a row. This one about RCI.
Hey, Justin and Luke. Just wondering what you guys thought of Rogers Communications, ticker symbol RCI, Romeo Charlie India. I saw that it had quite a few buy ratings on my investment app, and Morningstar has it listed as a 5-star right now. So just calling to see what you guys thought of it. I was thinking about picking some up. Appreciate it.
So this question about Rogers. This was about Rogers Communications. If you look on here, it looks like I typed in RICK, which is not what was asked about. So Rogers, oh, there it is. It's because RCI. Yeah. Anyway, if you're not watching this, what I just said doesn't make sense. If you're watching at home, you'll notice that a different company pulled up. But regardless, RCI is Rogers Communications Inc. And that's down about 21% year to date. And I think it's had an issue that a lot of communications, telecom, infrastructure companies have had. This is the biggest wireless communications service company in Canada, I believe. And one problem here is a problem that a lot of companies have had within the space, and that is a lot of debt. There's about $34 billion in debt on a $19 billion market cap company. Its interest coverage ratio is only 2 times, so it's operating in a pretty levered way, and its profitability has been falling. And so you actually see that as well in its performance versus the S&P 500. I don't know why this is showing the S&P 500, given that this is a primarily Canadian name, but not gonna get into that. So taking a look at their chart, at least since January, since the beginning of the year, it's been in a pretty consistent downtrend. It just broke down below its lower support level. So, I got to say, even though it looks like someone told you should buy this name, I think they have too much debt. Frankly, I think they're too levered. It's a very expensive business to be in telecommunications. Their strength is just not there. Their profitability is falling. Their sales growth has been pretty flat over the past couple years. So overall, I would say no on this one. Too much debt. Thanks for the call. Now, as you know, it's Friday, and on Fridays, we generally like to make the time to fit in a quick rundown of key benchmark numbers. So let me hit you with that list right now. The 2-year Treasury yield was at 4.6% today. For perspective, last week, that number was 4.74%. And about a month ago, that was 4.857%. 119 weeks back, that was 1.961. The 10-year Treasury yield was at 4.281%. Last week, that was at 4.388%. About a month ago, it was at 4.4%. And 129 weeks ago, that was at 1.7%. Gold was priced at $2,388 per ounce today. 2 weeks ago, that number was at $2,317. 23 weeks back, that number was $2,018, and 123 weeks ago, that number was $1,806. Silver today was at 31.38 per ounce. Last week, that number was 29.14. 5 weeks back, it was 30.37. And 116 weeks ago, the number was 23.94. Oil was selling for $83.63 per barrel today. Last week, that number was 81.51. It looks like the price increase is likely due to entering the busy season of driving. 11 weeks back, it was 83.10. And 113 weeks ago, that was $97. The national average for a gallon of regular gasoline is $3.51 per gallon. It's a 1 cent increase over last week. 6 weeks ago, it was $3.60. 57 weeks ago, just over a year, it was $3.56. In California, it was averaging $4.79 per gallon, down 1 cent from last week. I'll take any cent I can get. 5 weeks ago, it was $5.07, and 36 weeks back, it was $5.32. For comparison, in Texas today, gas was averaging $3.09 per gallon. That is $1.70 less per gallon than gas in California. Speaking of resources, let's talk a little bit about mines. And so mining trade groups are planning a campaign to revive and expand the Bureau of Mines, which you've probably never heard of. And so their aim here is to streamline U.S. regulations and support for critical mineral products. Now, the push is timed for the 2024 presidential election for a reason, and will launch ahead of the Republican and Democratic political conventions. These groups argue that the current U.S. mining policy, spread across multiple agencies, which include the Bureau of Land Management and Fish and Wildlife Services, really lacks a cohesive, unified approach that countries like Australia, where mining is very successful, implement. And in Australia, mining agencies report directly to the head of government. So the Bureau of Mines, which used to be a thing, it closed in 1996 due to budget cuts, historically managed mining inspections, conducted mineral-related research, and a bunch of other functions without overseeing mine permitting itself. The advocates for its revival believe that a centralized agency could improve efficiency in the permitting process and enhance U.S. competitiveness against major producers like China. However, critics make some good points, arguing the reintroduction of the Bureau won't really address the fundamental challenges facing the industry, such as the opposition from conservation groups and environmental regulators. Additionally, elevating the Bureau to a cabinet-level agency is a move that would require the head to report directly to the president, would need congressional approval, not just in the movement of that agency, but the appointment of the head of that agency. And so the proposal highlights kind of broader discussions about government efficiency, industry regulation, and national competition in critical industries like mining, especially in the wake of really what is the largest shakeup to federal agency regulatory powers in the last half century, when the Supreme Court handed down its decision on Chevron deference. So it'll be interesting to see how the mining industry is able to move the political parties in an election year, and if we'll add another cabinet level position, the Secretary of Mines, to the federal government. Now, this is InvestTalk. I'm Luke Guerrero, and we have one goal here: to help you achieve financial freedom. Our work continues after this break, so get your questions in now at 888-99-CHART.
Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Let's go to Richard in Santa Clarita, who has a question about NAC.
Yes. Hi, Luke. This is a question actually I had asked Steve about a year and a half ago.
Okay.
And it's NAC. It's a muni bond fund, California. And I asked him about, investing in it in the long run. And he said really was favorable on it in that he said, by looking into this now, you are looking through the windshield, not the rear view mirror, because if interest rates drop, which was the projection, a year and a half, we'd have, a number of interest rate drops, in the future, in near future. He said this bond fund, it would go up. And it was a good way of looking at this. My question now is, we're not seeing as many interest rate cuts in the future necessarily, maybe one, maybe two. And the other thing is, with the status of the California budget and everything, how about the risk of this type of fund, if the state ends up having budget funds? So I guess my question to you, what would you say about this particular bond fund in terms of investing in at this point, and contributing to it regularly to try to be as far as being a good investment?
Okay, so let me ask this first because I'm having some trouble finding it. Is it a intermediate term bond fund?
Symbol is NAC, Nuveen Muni Bond. So
Let me see. Just give me 1 second here because my system is not really finding it, because that might not be like the ETF ticker. So give me 1 second.
All right.
Yeah, so I can't really find it. So I won't get into the specifics on the bond fund itself. Let me ask this: is it a short term or medium term or long term bond fund?
Well, I believe it's closed bond. It's the Nuveen California Quality Municipal Income Fund. So it's a closed fund, and obviously it's multiple bonds.
Yeah, of course. So generally speaking, I think there's some important things to know. One is municipal bonds you should not be investing in unless you are in a top income bracket. And that may apply to you, but generally for everyone who's listening, the way you should be looking at bonds, people love not paying taxes, but what you want to be thinking about is the after-tax return. And so municipal bonds are great for people who are very high income because you get the tax break and you are high income. And you don't have to, it's more beneficial for you. But the reason they price them lower is keeping that tax break in mind. So you actually may be better off investing in a fund that is non-municipal bonds. And that's why you have to look at the after-tax return. So assuming that is the case for you, I would say that yes, over the shorter time horizon, it appears as though rates are not being cut as drastically as they anticipated earlier in this year. But from a general perspective on the federal government and the California state government, current rates on a federal level are priced such that the interest on debt is incredibly high as a percentage of not just GDP, but as a percentage of the overall federal budget, which means it is unsustainably high for rates to be as high as they are right now for much longer. And so even though you see, first rate cut might be in September, first rate cut might be in December, rates are going to have to go down. And over the past 2 years, you've seen a historic wealth destruction in terms of some of these bond funds. And so Steve was correct back then, but he was just wrong about the time frame. I think that although in the long term, rates are going to be higher than they have been, it doesn't mean that in the long term rates are going to be high, right? I still think rates are going to come down. And so some of these bond funds that have been priced such that, we've been higher for longer on a price appreciation basis are going to do, I think, pretty well. But again, keep in mind the first part of this answer, which was municipal bond funds are only good for a few people. Keep in mind, it's always about after-tax return. Thanks for the call. Now, I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. You can get yours anytime at iTunes, Google Play, and Spotify. Please be sure to rate and review us on iTunes. You can also watch us on the InvestTalk YouTube channel. That's InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.